July 1944, 44 nations gather to rewrite the world's financial order, placing their trust and their future in the hands of the US dollar. That bargain would make America's currency the undisputed king of global trade, outliving gold, crises, and even the collapse of the British pound. But today, that foundation is shaking. BRICS. Nations are building alternative systems. China is pushing a digital yuan. US debt and inflation are spiraling. What happens when the dollar falls from its global throne? And how could that upend not just markets, but the price of everything you depend on? This is the real story behind when the dollar falls, the day America loses its global throne. Would you see it coming? At the height of World War II, the world's financial future was being hammered out in the shadow of the White Mountains. Inside the Mount Washington Hotel, delegates from 44 nations debated the rules that would govern money and power for generations. The United States arrived with a clear advantage, its economy intact, its gold reserves towering over war-ravaged rivals. American Treasury official Harry Dexter White pressed for a system where the dollar, anchored to gold at $35 an ounce, would become the axis of international exchange. British economist John Maynard Keynes, representing a battered empire, argued for a new global currency, the Bancor, to prevent any one nation from holding too much sway. Behind closed doors, diaries and memos reveal tense exchanges and late-night edits. The final wording shifted from gold and gold convertible exchange to gold and US dollars, a subtle but decisive change. The International Monetary Fund and World Bank were born from these negotiations, designed to stabilize currencies and rebuild shattered economies. Every country agreed to peg its currency to the dollar, and the dollar alone would be exchangeable for gold. The agreement signed in July 1944 set the dollar as the world's monetary anchor, its value backed by the promise of American gold. This was more than a technical fix. It was a bet on American stability and a framework that would outlast empires. The world's trust in the dollar, forged in that New Hampshire summer, would shape the next era of global trade and prosperity. August 15, 1971. President Richard Nixon appeared on national television and, with a single announcement, severed the dollar's last tie to gold. From that moment, the promise that any foreign government could exchange dollars for gold at $35 an ounce vanished. The world entered a new era, the age of fiat money, where the value of the dollar rested on confidence alone. Nixon called it a temporary measure, but the gold window never reopened. Central bankers scrambled to adjust. Headlines warned of currency turmoil as the dollar floated freely for the first time. Yet the dollar's dominance did not collapse. Instead, it found a new anchor: oil. In the aftermath of the 1973 oil crisis, U.S. officials began a series of quiet negotiations with Saudi Arabia. Treasury memos and declassified cables show the urgency. To keep global demand for dollars alive, oil had to be priced in dollars, and those dollars needed to flow back into U.S. financial markets. By 1974, a secret pact was in place. Saudi Arabia agreed to price its oil exclusively in dollars and to invest its surpluses in U.S. Treasury securities. In exchange, the United States provided military protection and technical support. The arrangement was never codified in a single treaty, but it reshaped the global system. Oil exporting nations recycled petrodollars into U.S. assets, fueling American deficits and cementing the dollar's supremacy in world trade. The dollar, once tied to gold, now drew its strength from oil and the machinery of global finance. This new order would face challenges, but for decades, the petrodollar system kept the world's reserve flows running through New York and Washington. The foundation laid in these years explains why. Half a century later, threats to the dollar's throne still target energy reserves and the confidence that binds them. In 2024, the BRICS alliance gathered in Kazan, Russia, unveiling a new phase in their campaign to reduce reliance on the dollar. The summit's final communiqué outlined a coordinated push for alternative payment systems, with the new development bank at the center of these efforts. Documents from the NDB's technical working group describe a patchwork of new settlement rails, cross-border platforms linking the Russian SPFS, China's CIPS, and India's Unified Payments Interface. These systems, once limited to regional trade, now process a growing share of transactions between member states. In the first quarter of 2024, official NDB figures show over $12 billion in trade settled outside the dollar, a figure triple the volume reported just 2 years earlier. China's digital Yuan, the ECNY, has moved beyond pilot stages in select corridors. The People's Bank of China reports that by mid-2024, cross-border ECNY transactions with the United Arab Emirates, Russia, and several Southeast Asian partners surpassed $4.5 billion in aggregate volume. Transaction logs, published in BIS technical annexes, reveal that these digital settlements, while still small compared to global SWIFT flows, are now routine for certain oil and machinery trades. Russian exporters, for instance, have begun receiving payment for crude oil in ECNY, clearing through regional banks in Shanghai and Moscow. Emirati logistics firms settle port fees and equipment invoices using the same rails, bypassing dollar conversion entirely. An on-camera interview with a senior NDB official adds a human face to this transformation. She describes the operational realities. Every transaction must bridge different regulatory regimes, technical standards, and compliance checks. Settlement times, once measured in days, are now down to hours. Yet, she notes, liquidity remains a challenge, especially for larger trades that would once have defaulted to dollars. Internal NDB memos leaked to international media highlight debates over scaling up. India and Brazil express caution about overcommitting to new rails, citing concerns about market depth and convertibility. But the direction is clear. For the first time since the end of Bretton Woods, non-dollar payment rails are not just theory. They are operating in the wild, moving billions, and inviting the world to imagine what comes next. Russian customs records from early 2024 show a new kind of invoice. Oil shipments to China billed in yuan, not dollars. Payment confirmations trace the funds through Gazprom Bank in Moscow and regional branches of the Bank of China. The transaction logs, now standard for sanctioned exports, bypass SWIFT entirely. In parallel, Iran's port manifests list machinery and grain trades, settled in dirhams and rupees, sometimes through barter, sometimes through regional payment rails. These deals, once rare, now appear routinely in trade finance bulletins. The dollar's grip on energy settlement, once near total, is slipping at the margins. Official IEA data puts dollar-denominated energy trade just above 80% in 2023, down from nearly 90% a decade earlier. As sanctioned states find ways around U.S. restrictions, pressure builds on the American side of the ledger. Treasury auction reports from the first half of 2024 reveal a subtle but persistent trend. Foreign participation in new debt sales is thinning. IMF debt tables show U.S. debt to GDP rising above 130%, while Congressional Budget Office projections warn of trillion-dollar deficits extending as far as the eye can see. The Consumer Price Index, after peaking above 9% in mid-2022, remains elevated. Food, rent, and energy costs are slow to retreat. For households and businesses, the result is a squeeze. Grocery bills up 17% over 2 years. Mortgage rates for new loans above 6.5%. And small importers facing double-digit swings in costs as they navigate new currency corridors. Market analysts pore over the customs and payment network data, watching for signs that these workarounds are scaling up. Each new non-dollar invoice chips away at the network effects that have long anchored the dollar's role. Meanwhile, the U.S. faces a mounting challenge, funding persistent deficits in an environment where global demand for treasuries is no longer guaranteed. The mechanics of reserve currency status, once invisible, are now under strain from two sides at once: sanctioned states bypassing the dollar, and America's fiscal and inflationary burdens, testing the world's confidence in its promise. Central banks keep a close eye on where they park their reserves. In the late 1990s, nearly 3/4 of the world's official reserves were held in US dollars. Now IMF-COFER data shows that share has slipped below 59%, a steady erosion over a quarter century. Each percentage point that shifts away from the dollar means fewer treasuries bought by foreign governments and more pressure on the U.S. to offer higher yields to attract buyers. According to recent sensitivity studies, a 10 to 20% decline in the dollar's reserve share could push U.S. Treasury yields up by 40 to 100 basis points, all else equal. That's not a theoretical risk, it's a direct cost, affecting the interest the government pays on trillions in debt. IMF economists tracking these flows point to inflection points: the 2008 financial crisis, the rise of the euro, and more recently, the adoption of alternative payment rails by BRICS members. Each episode saw a measurable blip in diversification, but the trend is cumulative. As central banks diversify, the mechanics ripple outward. Higher yields make U.S. borrowing more expensive, and the cost is passed through to mortgages, business loans, and government spending. At the same time, a weaker dollar can feed into global inflation, raising the price of imported goods and commodities for American consumers. These are not abstract shifts. They're the invisible gears that connect central bank decisions in Beijing or Frankfurt to the price of food or fuel in Des Moines. The data may look technical, but its impact lands at the kitchen table. A retired couple in Ohio flips through their grocery receipts, trying to find places to cut back. Their Social Security checks haven't changed, but the cost of food has climbed 17% in 2 years. They scan their budget spreadsheet, watching the margin shrink. Electricity bills eat into what used to be set aside for small luxuries: a weekend drive, a dinner out. Every price hike feels personal now, not just a headline. In Houston, a young family who bought their first home in 2021 now faces a different reality. Their adjustable mortgage rate, once manageable, has reset above 6.5%. The monthly payment is nearly $400 higher than it was last year. They debate whether to refinance, but the math no longer works in their favor. The dream of homeownership, once a symbol of stability, now comes with a constant undercurrent of anxiety. A small importer in Los Angeles checks the latest invoice from a supplier in Shenzhen. The cost of machinery swings wildly each month, tracking the unpredictable dance between the dollar and the yuan. Settlement delays mean shipments sit in port, waiting for payments to clear through new, unfamiliar rails. A single miscalculation can erase a quarter's profit. In a pension fund boardroom, managers review models that no longer fit the world they knew. With treasury yields rising and foreign buyers thinning out, the fund's long-term liabilities must be recalculated. A 3 to 5% revaluation could mean adjusting payout expectations for thousands of retirees. The numbers on the screen translate into lives, hopes deferred, plans rewritten. For each of these stories, the forces reshaping the dollar's place in the world land not in theory, but in the texture of daily life. The lessons of history are not distant. They echo in every bill paid, every plan postponed, every conversation about what the future might hold. Calls for a return to gold-backed money have grown louder as faith in the dollar wavers, but the numbers tell a different story. The World Gold Council puts the world's official gold reserves at about 35,000 tons, roughly $2.5 trillion at today's prices. Yet global foreign exchange reserves sit near $12 trillion, and the daily churn of international payments is far greater still. The entire above-ground stock of gold, including jewelry and private holdings, comes to about 210,000 tons, but only a fraction of that is available for trade. Most is locked away, illiquid, or simply not for sale at any price. In London, the bullion market clears around 20 million ounces of gold a day, about 620 tons, or $40 billion at $2,000 an ounce. That sounds impressive, until it's set beside the $6 to $7 trillion in daily global currency trades, nearly 90% of which involve the US dollar. Even if every ounce traded in London and on COMEX in New York was available for global settlement, the annual notional turnover of gold, between $10 and $36 trillion, barely matches what the dollar handles in a handful of days. And most gold trades are not physical deliveries. They're paper contracts, closed out before any bar ever leaves a vault. Central banks and reserve managers prize liquidity above all. Settlement needs to be instant, seamless, and on a scale that matches the needs of global trade. Gold can't deliver that. Physical settlement is slow, costly, and fraught with logistical hurdles, the very qualities that make gold reassuring. Scarcity, permanence, also make it unfit for the real-time demands of modern finance. A reserve system based on gold would seize up under the weight of daily commerce, choking the flow of oil, machinery, and food that keeps the world running. Expert studies from the IMF and World Gold Council agree gold's market depth is robust for investors, but nowhere near sufficient to anchor a reserve system for the 21st century. The gold illusion persists because it's simple and evocative. But the reality is clear. No matter how loud the calls for a gold-backed alternative, the numbers refuse to cooperate. The world's settlement needs have outgrown what gold can provide. 3 futures now stand before the dollar, each shaped by forces already in motion. The first is the path of slow erosion. In this world, the dollar remains the world's primary reserve, but its share continues to slip, falling from 59% today to just above 50% by 2030. Central banks diversify gradually, shifting reserves into euros, yuan, and gold. U.S. Treasury yields rise by 40 to 60 basis points, making government borrowing more expensive but not catastrophic. For most Americans, the impact is felt in higher mortgage rates, modestly rising import prices, and tighter government budgets. Market volatility increases, but the dollar's deep liquidity and global trust hold the center. This scenario, according to estimates from the IMF and major banks, carries a 50 to 70% probability, still the base case for most experts. The second scenario is a world of multipolar reserves. Here, alternatives to the dollar, regional currencies, digital payment rails, and even gold-backed units gain significant ground. The dollar's share of global reserves drops more quickly, falling to the mid-40s by the end of the decade. U.S. yields rise by 80 to 120 basis points, a move that ripples through every loan and investment. Oil and commodity prices begin to reflect baskets of currencies, not just the dollar. BRICS, payment systems, process a sizable share of trade, and central banks in Asia, the Middle East, and Africa hold more of their reserves in non-dollar assets. For the U.S., this means persistent inflation pressure and more frequent financial shocks. Probability bands from IMF and BIS research put this outcome at 25 to 40%, a real, if not dominant, possibility. The third scenario is the sudden dethronement. A sharp loss of confidence, triggered by political crisis, fiscal breakdown, or a major technological leap, pushes the dollar's reserve share below 40% in just a few years. Treasury yields spike by 200 basis points or more. The cost of borrowing soars for households, businesses, and the government. Stock markets reel, and the world rushes to find new anchors for trade and savings. Experts assign this outcome a 5 to 10% chance, unlikely but not impossible. Each scenario rests on a different mix of policy choices, global shocks, and technological change. The probability bands are not predictions, but boundaries, shaped by data, expert interviews, and the lessons of history. The future of the dollar is now an open question, with the answer written not in certainty, but in the shifting numbers of a world in transition. In 1999, the US dollar made up 71% of global reserves. By 2024, that share had dropped below 59%, according to IMF data. Documents from the Bretton Woods Conference and secret 1974 US-Saudi memos reveal how American policy shaped this era of dominance, but also how quickly systems can change. Today, BRICS nations are building alternatives. Digital Yuan pilots are underway, and the United States faces a debt-to-GDP ratio over 130%. Mortgage rates now exceed 6.5%, and grocery prices are up 17% in a single year. Clear signals that global shifts reach everyday households. Yet, uncertainty remains. Key agreements and future decisions are still classified or unsettled. The fate of the dollar now depends on choices made in Washington, Beijing, and beyond. History shows reserve currencies can adapt or fall. What comes next is not inevitable, but shaped by policy and trust. The dollar's throne is no longer guaranteed.